Hello, good morning, and welcome to today's Monday morning money briefing, where we'll be giving an overview of the major headlines of last week and hopefully breaking them down into what that means for you, your money, and your investments as well. Just shortly, I'm going to share the Slido link in the chat, which is where you should be able to ask any questions that you might have whilst we're going through. If you've got any questions that come up afterwards as well, you can always reach out to us on hello at myfinancialfreedomcoach.co.uk. Or, of course, you can reach us through any other method, be it through connecting on LinkedIn or Instagram as well. You'll find us there, hopefully, relatively easily, so don't hesitate to do so. This is also recorded, and we now put them up onto YouTube afterwards and share the link with you. So if there's anything you want to come back to as well, you should always be able to do so. That is, of course, if you are joining us here live today, versus joining us later in the afternoon. You know what I was going to say? You can't do anything other than join us live or on the recorded version. I was going to say in person, but that's, as I say, not possible, unfortunately, for these Monday morning briefings. But we are, of course, at the 1st of December as well. And last week was a bit of a whirlwind. So I think I'll get straight into what we were all here for, which is, of course, last week's major headlines. So if this is your first Monday morning briefing, or if you've been to a few, then the agenda looks a little bit like this. I'm going to go into one step that you can take to get a little bit closer to financial freedom based on what I, or indeed any of the other founders of Financial Freedom Coaching, have done. We then leap into what's happened in the UK before going into over the pond on the US, a read of the week, taking a look at Europe and the rest of the world as well. So, one thing that I've done to get me a little bit closer to financial freedom in the last week to kick us off and just to have a little bit of a think about it is that I've done a little bit of a rejig on some investments. It's something I'm going to be talking about very soon on social media because it's been a real experiment and a journey for me. I spent a period of time living overseas, which meant that products like ISAs that we have in the UK weren't available to me. So I had a slightly different portfolio, and I started out with a range of different funds, but also stocks. And I've closed that platform and moved it into now my ISA, meaning that there's been a bit of an opportunity for a rejig because I haven't just bought what I had before. And actually, what I found is that I've moved away from a lot of those single stocks. But as I say, watch this space because I'll be talking about it a lot more, hopefully, on social media because I think it's certainly a really interesting one. And a lot of people, I think, don't believe that they're investors somehow until they've invested into stocks, when actually, for most people, they're not the right decision. And so, looking at the difference between those stocks, funds, and ETFs is really, really key, I think, to building confidence and belief in your journey as well. So let's take a look then at the markets where we've got an absolute sea of green, which makes a bit of a difference to what we've seen in some previous weeks. The FTSE 100, which is a measure of the 100 biggest companies in the UK, was up by 1.9% for the week. And it was a big week for the UK, which I'll come on to talk about just shortly. We also saw the S&P 500, so the measure of the 500 biggest companies in the US, climb by a whopping 4.47%. The Nasdaq, which is the US tech index, was up by 5.43% for the week. So again, a huge week for the US in terms of ups. But really, if you've been following for the last few weeks, you'll know that we've seen some red and down figures. So it's what some might just call a bit of recovery. Certainly been a speedy recovery, and certainly for a week that the US markets had a holiday, because last week was, of course, Thanksgiving in the US, and that means that there are shorter trading hours. One day is closed, and Black Friday is only open for half of the day on the market. So really, their markets are only open for 3.5 days. Now, if you're already sat there thinking, does this mean that things will be better or worse? Generally, actually, it just means it magnifies whichever way that the markets go because there's less days for it to pan out. It's much more concentrated. And clearly, it's magnified it in the positive end this week. And then the Euro Stoxx 50, which is a measure of the 50 biggest companies in the Eurozone, ended the week also up by a healthy 2.62%. So you can use these index readings to firstly start to celebrate some of the wins, and it can help to get a bit of a grounding in what's actually going on within markets and not just within the doom and gloom headlines that often come out of the media. You may well have seen similar figures reflected in your own portfolios with a relatively positive week, but sometimes it doesn't always translate quite so quickly. So you can also use them to try and understand and establish some of the reasons for the rebound and have a think about your overall portfolio makeup, how that might be impacted, and what that short to medium term could look like within your investments as well. But overall, I'd say that as we move into this festive month, I know a lot of trees are up in the UK, we can certainly celebrate the wins as they come for this Monday morning. So what's happened then in the UK? Well, last week, as I say, was a big week where we saw the UK budget announced. This is where the Chancellor, Rachel Reeves, comes out with her red box and tells us the changes she's making to taxation in order to balance the UK's government, quite literal, budget. There have been so much speculation and hype. If you've joined these Monday morning briefings before, you will have certainly heard about it. There was almost an unprecedented level of hype, and indeed, as a chancellor and the prime minister, they were even sort of critiqued for it because it was seen to be actually going a little bit over the top when it came to the things that they were doing to generate this speculation. Now, I suspect personally that this is something that they knew they were doing because they've done it before when we've come up to other briefings, and what they're doing is preparing us all for the worst, spreading the news around, oh, it's going to be income tax that goes up, it's going to be this, it's going to be that. And there's a general feeling of fear across the nation. And then actually, when it gets released and it's not nearly as bad, everyone goes, oh, that's fine then, because they've been preparing for something somewhat worse. Now, whether that is a good thing or a bad thing, who knows? Because then it makes us perhaps not quite critically assess the eventual outcome as much as we otherwise would. But it certainly makes us more positive about it because we thought it was going to be so much worse. Now, the UK budget, as I say, was released and it was a mixture, a mixed bag. In my opinion, again, a little bit of something and nothing all in one go. We didn't see income tax change, but we did see income tax freezes. What that means is that whilst right now we won't see any change to our income tax threshold in the UK, we may well see over time that more of us end up paying more tax because of inflation. Generally, when our wages rise with inflation, this means that we get dragged into higher tax brackets and something known as fiscal drag. We've also seen an increase on taxes with property, rental income specifically, and dividend taxes increasing. Now, if you hold investments within ISAs or pensions, this increase in dividend taxes won't impact you. But it will impact you if you're a small business owner who pays yourself in dividends because your tax rates as of 2027 are going to go up a little bit as well. There's then some also slightly more random ones. So there is a change to salary sacrifice within pensions. There is a change to owning a house over the value of 2 million, the so-called mansion tax, which is going to be taxed at a higher rate. And there's also some random ones out there, including the increased mileage costs on owning an electric vehicle, as well as also milkshake taxes. Lots of different ones came out, but overall, the markets, both stock, bond, and currency, have all responded positively to the news. It seems that all the jitters in the run-up were worth it because actually, ultimately, it's been digested well. And as I say, we see on the stock market, the FTSE 100, the bond market, and the currency market, the pound, have all seemed to digest this very, very well. So this means for you and your money that actually, if we're looking at it from an investment perspective, it's likely been quite a positive outcome. If we're looking at it from a money in your pocket perspective, it's still probably quite a positive outcome. The changes that have been announced are all mostly coming in from April 2027. And what this means is it's quite a long time to adjust. There's no need to do anything on a knee-jerk reaction. And frankly, most of them that may impact you there's not a lot you can do about them other than just be more efficient and continue to invest in efficient ways. So, on to then what happened in the US, where, as I say, we saw quite a large rebound in the overall markets. Now, a lot of this has been appointed to the fact that the Federal Reserve, often shortened to the Fed, which is the central bank in the US, announced that it is very likely that they will be cutting interest rates in December. This was received with really, really positive vibes, as we saw in the stock market readings. We've also had a fair few weeks, perhaps even arguably months, of jitters around AI. Lots of people have been worrying and speculating that AI is overvalued as a sector, that actually the stock valuations of companies hinged on AI are getting way too big for their own boots, and this is going to cause some sort of bubble which could well pop. Now, what we saw over the last few weeks is that this has eased, thankfully, mostly down to the fact that Nvidia reported earnings, Nvidia being the company with the largest market cap in the US at the moment, but also the biggest chip maker for AI language learning models and other AI associated technology. Nvidia's earnings was super, super positive, and this meant that everybody kind of breathed out a little bit around that AI bubble. And that's why we've also seen this rebound in the stock markets. But closer to home, we also saw information and new data released around US ETFs. Now, in most countries, there are some tax breaks on certain investments. ETFs is often one of the ones on that list, particularly if they're domiciled. So, if the fund is housed in that nation, in the home country, if you like. And it's no exception in the US. So ETFs that are based in the US, if you're a US individual also living in the US, have certain tax benefits that come with them. But as I say, depending on which country you're in, it may well be the same for you too. It's the same in the UK. It's just not one that's widely publicized because the vast majority of people are working through ISAs anyway. And these generally come with their own tax benefits that far outweigh what you could get if you just use this ETF loophole. For the US, these ETFs exploiting the loophole are attracting billions. Now, what this is doing is prompting political scrutiny and then therefore potential warnings of the tax authorities getting involved and changing the legislation around them. This is because tax-focused ETFs, or those that come with tax incentives, could distort some sort of capital flows, i.e., it's heavily incentivizing people to invest into ETFs rather than other types of investments. And this may not please, for example, a president that really likes the financial sector that could earn a lot of money through the likes of managed funds, hypothetical. So what this could mean is that they start to move away from the popularity of ETFs. Now, it sounds like kind of a minor thing. You're like, this is like a tiny little legislation in the US. But actually, there is potentially a broader knock-on impact for the rest of the world as well to be aware of. As I mentioned, President Trump has certain leanings and powers within the financial services sector. Now, historically, actively managed funds, where there's a human in charge of picking the different investments that are in it, are more expensive for us as investors, but generally make more money for the companies that are running them because we're paying more. Now, what that means is that as a sector, they really probably want more actively managed funds if they're looking at it purely from a financial perspective. If we're looking at it from a retail investor perspective, we probably want the lowest costs possible, be it through ETFs or indeed actively managed funds. But more often than not, it's going to be through ETFs. So if there's a sudden strangulation on how easy it is to access ETFs, or indeed the incentive that investors have to go into them, this could well ripple across the rest of the world, where we've just seen ETFs really start to get popular because they're so simple, easy, and cheap. It's not necessarily one that's going to change overnight, so don't panic if you're sat there with ETFs thinking, is Zoe saying this morning that they're going to go away? I'm not saying that at all. I'm saying this is part of a wider trend that I will keep an eye on, and you should as well, that actually Trump may well influence some of what happens within those choices that we have and within that financial services sector. He's only in office for 3 more years, so if you keep that long-term view in mind, hopefully everything will rebound. But a longer term trend that could be an interesting one to watch. On to then the read of the week, where the BBC talked about the UK very specific budget that came out this week. It looked at ISAs, cars, and pensions. I forgot to mention both cars and ISAs in that first section, but the budget was quite far reaching and there was a relatively long list of things that they were allowing into that budget. So, as I say, they've frozen income taxes, raised the thresholds, raised taxes on savings, as well as property. And EVs and high value homes will also see. Now, the cutting cash ISA limits is a funny one. So, this was rumoured again for weeks and months beforehand. For anybody that's unaware, the cash ISA is just like a savings product, but it comes with tax incentives. What the UK government really want, and what many other governments also really want, is to move more people into investments rather than holding money in cash. They particularly want to move money into their home domestic investments as well, because it helps to boost their stock market and hopefully eventually their economy too. So, what the government have decided to do is reduce how much cash you can hold tax-free in a cash ISA. But it's small. As of 2027, if you're under 65, your max allowance will be 12k per year to go into a cash ISA. Now, this is coming from a government that also said they wanted to simplify the ISA scene. In my opinion, this isn't simple, but here we go. The idea is that it's going to channel more people into investing, which I'm all for. It's a great idea. But it can also mean that there's extra complexity. And really, how many people are feeling the effects of those reduced 8k per year? Who knows? Maybe the figures are bigger than we realize, but it seems like a relatively niche impact that it will have in terms of incentivizing people to invest. Let's take a look then at what Europe was up to. In Switzerland, there was a vote, or there will be a vote, on a 50% inheritance tax for estates above 50 million Swiss francs. Now, there is some inheritance tax in place in the vast majority of cantons in Switzerland. Switzerland operates a little bit like other nations, but if you think of the US as an easy one, whereby each canton has its own tax rules, much like each US state has its own tax rules as well. There is still that overarching one that's there, but they set their own tax rates. Now, this inheritance tax is really interesting, and Switzerland as a nation vote on a lot of major decisions. So they go to the voting polls a surprising amount. So that part in itself isn't too big. But it's, of course, raising concerns amongst wealthy residents and family offices. This inheritance tax is rumoured to also impact the likes of spouses and children, which the current ones don't normally do. So even a narrow rejection fuels uncertainty, which could potentially shift flows and reduce Switzerland's appeal as a stable, low-tax hub for wealth. I think we're going to see more and more of this pop up across the globe. Norway did it recently, and reportedly, there was a huge exit of very, very wealthy people, mostly to the Middle East. Switzerland are now talking about introducing it, and of course, it's an ongoing chat within the UK as well, that taxing the super wealthy on various different outputs, such as inheritance tax, of course, helps to even things out within society, but also helps to boost the government's revenue from taxes in a way that hopefully impacts people in different ways. As I say, I think we're about to start to see more of this, particularly as governments are suffering and trying to find different ways to raise taxes. But what it could mean is that we start to see a shift of those traditionally wealthy hubs. Norway, Switzerland, if they all start to shift, things could really start to change. But there's always a payoff. Taxes pay for certain things that we enjoy within society. And whilst the UAE may have very low tax levels, you do pay in other ways, be it through health insurance, be it through other systems within the country. The EU business regulation, then, the EU Innovation Fund, has reportedly only paid out 5% of their fund due to extreme bureaucracy and stalling green tech deployment. There is a fund then that is there to help these small businesses, and it's really not helping. So this slow funding weakens EU clean tech competitiveness and it discourages investment. It might also push high growth innovators to relocate to faster moving markets, which isn't great news for the EU. So, what does all this mean then for you and your investments? Well, if we're looking at that EU growth fund, it doesn't necessarily mean anything superbly major unless you're investing into small businesses in the EU. But what it could mean is a wider indication of what the scene in Europe is like for small businesses: slow and bureaucratic. Only 5% of the fund is really a tiny amount. Now, of course, we haven't got the wider detail around why or the wherefores, but we get the idea. It's often a criticism that is levied at both Europe and the UK that things are too bureaucratic and other markets like the US are better for funding. This isn't great news for the longer term view on the likes of their stock market and also innovation. But it's just one aspect to it. So, yeah, what does this mean for you and your investments? Well, it certainly means that when you're looking at, for example, investments in Europe versus investments in other parts of the world, we do tend to see slightly slower movement and slightly slower adoption of innovative products. So, if you're looking, for example, for specific green tech or new technology emerging, it does generally take a bit longer to come through. It's not a bad thing because that bureaucracy can often mean that there's a bit more stability. But it's one to bear in mind when you're thinking about the spread that you've got, the diversification, and if you're scratching your head as to why you can't find certain things. And then on to the rest of the world. First up, China, where Hong Kong's equity issuance, so how much they're putting out in terms of listing on the stock market, has surged to 4-year highs. Chinese companies are reportedly tapping global banks for over 70 billion in fundraising. Hong Kong has seen a little bit of a bounce back, and what this means is that it's relatively positive news for the region. Now, you may well be invested into Hong Kong through the likes of Asia funds or indeed through the likes of more developed market funds as well. They've had a rough few years, particularly post COVID, and this is relatively positive news that they are coming back alive and kicking. Now, of course, in Hong Kong last week, there was the really sad news of a huge fire that took place that unfortunately took the lives of many. This did have an impact on stock markets as they saw their stock markets fall a little bit last week, and particularly within the insurance sector, as the insurance company itself and the construction company behind the building that was burnt down were looking at some potentially high costs. So on to then Afreximbank, where Afreximbank plans to expand financing for regional trade and value-added processing as shifting US policies reshape Africa's economic incentives. If you have, for example, investments into the likes of emerging markets, it's likely that there are some African nations in there, and some are growing at a booming pace. They are ever more expanding, and with a push from Trump last week into their banking, this could only become ever more positive for them. It's certainly an area to watch if you're interested in the likes of emerging markets within your portfolio. And as I say, if you do have a broader fund, you may well see them pop up in there too. And last but not least, onto India, where India posted 8.2% growth on their consumption and manufacturing. This is despite those US tariffs and trade tensions that they have been notably hit with. India has one of the highest tariff rates in the globe. This, some people might think, is posing real threats to them, but actually, this shows that still domestic consumption is looking pretty strong. And hopefully, their boom will really start to continue. Start to continue? Will continue in the way that it has. I'll move us on to the Q&A now, so do feel free to ask any questions that you might have in that Slido link. And if you've got anything that comes up within the week or afterwards, as I say, don't hesitate to reach out either via our email address at Financial Freedom Coaching. You can find me on Instagram at Words on Wealth. You can find me on LinkedIn as well. So do check them out if you've got anything else that you see pop up. And as I say, I do say it every week, but I'm deadly serious. If you do ever see anything that you pops up in your news in the week and you think that needs a bit more of a digest, just let me know because I always try and integrate it in if possible. So I'll just see if there's any questions that have come in. Nothing at the moment. It is, I know, bright and early on a Monday. In fact, it's not bright at all here. It's still relatively dark. But I'll give it a few more seconds just in case anybody does have any questions that they want to ask. It's also no such thing as a silly question, so don't hesitate to ask away, whatever it might be. All right then. Well, I think I'll round us off there if nothing is coming in. As I mentioned, you can get in touch with us in different ways too. Have a lovely day, a great week, and see you all soon. Bye for now.